think about how much better you'll be. Imagine if you did that before you traded for the day, for example. You sat at the charts, you got up at 6, 7 o'clock before market opens, and you spent 10, 15, 20 minutes back testing a week's worth of data. Every single day, you're doing a week's worth of trading before you've gone to market. So I'm going to talk through some things today that are part of the new trading plan. I'm still gathering data on them, so I've got the stats and the figures to go alongside them. It's using all the same strategy things that you're learning in the course, but it'll be a specific trading plan that you can use with kind of entries. Obviously, you've got the entry models already, but where you should be kind of placing stops, where then you should be placing your profit targets, and the reasons why, and just a little bit more structure around profit targets as well. Because we've got this kind of momentum-based trading strategy now, and what we're finding is a lot is being left on the table, I've noticed recently. If you're trading alongside momentum, then we should really be expecting price to continue, as you can see Euro USD is very clearly doing now. So just a way of kind of analyzing where price should go, and the reasons why it should go there as well, which I think will be really, really helpful to you guys. So yeah, some of this may be new, especially to those of you who've gone through the full course. Some additional modules I've got coming for you guys soon. Like I said, I'm just gathering the data on it, so I can come to you and say, look, I've tested this over 2, 3, 4 years worth of data. These are the stats, these are the figures, this is what you should be aiming for, etc. in terms of win rate, and just kind of go from there. The more testing I do with kind of a 2R, so when I do my back testing, I'm always going for kind of 2R trades. That's what I'm always aiming for. 2R trades, in and out, just making sure the setups and the models are working well, which I know they are, but it's if you're not doing it, just so you know, and you are trading, whether that's on a prop challenge, whether that's on a live account, if you're not back testing regularly, and I'm talking like daily, you don't have to spend hours on it, but do like a week's worth of trading every single day. Think about how much better you'll be. Imagine if you did that before you traded for the day, for example. You sat at the charts, you got up at 6, 7 o'clock before market opens, and you spent 10, 15, 20 minutes back testing a week's worth of data. Every single day, you're doing a week's worth of trading before you've gone to market. You're definitely going to make better decisions, right? You're definitely going to be making decisions and kind of honing your skills, sharpening your blade, refining that edge. And that's what it's all about. Something that personally I neglected recently, and me and Pete were talking about this over the weekend. I had a bit of a tough week last week. Didn't really make much. A couple of break-even days, one losing day, one winning day, a bit of a rubbish week. I expect to be making profit every single week, and a bit of a rubbish week last week. And one of the things that I realized is that I was away on holiday and various other reasons, but I had stopped backtesting because I know my strategy well, I know how to trade it, and it's really interesting how, looking back at the trades that I took last week, especially ones that failed, how what's the word I'm looking for? Basically, they just didn't meet my plan properly. They didn't meet those basic criterias that I wanted. As soon as then I've gone back and started my backtesting process, or backtested pretty much all weekend, backtested before market today, and it's your skill set and ability comes back really, really quickly. And I use this analogy all the time, but professional footballers, you look at your Lionel Messi's, Cristiano Ronaldo's, they are going in coaching and drilling over and over again. Basketball players, Kobe, LeBron James, all these people, they practice and they shoot their 3-pointers over and over and over again, so that when they get into a live situation, it's easy for them, right? It's just second nature. It's like muscle memory, and that's what we want with our trading. And like I said, for me, I hadn't done any back testing for about 2 or 3 weeks. Admittedly, I've been on holiday and various other things, and trading has been going really, really well. But I always say one of the worst things that can happen to a trader is a winning streak. It gives you this feeling of absolute confidence in what you do, and you do kind of feel invincible in those moments. So it's a really, really interesting psychological thing to make sure that you're just doing the basics all the time. Make sure you're shooting your 3-pointers every single day. Make sure you're taking your penalty shots every single day. Make sure you're practicing these things so they become second nature, so that when you get into live markets, you can't make mistakes. And really, it's as simple as that. So let's talk through the price action today, because today was a little bit difficult to read. Can everyone see my screen? Or is it just on Zoom?
Yeah, bro.
You can see my screen, yeah?
Yeah, I got it.
Okay, cool. Right, so I'll hide this for now, and I'll get rid of this, and we'll leave the trap on there because we know where that is, and we'll just go in. So look, I took a long earlier today, okay, and would I say that's an invalid trade? Well, yes and no. Okay, we are in this 15-minute range. Okay, we are in this 15-minute range, and where I think I went wrong this morning is I should have expected, after all of this bullish price action, especially with the bullish price action overnight, I should have expected a pullback into our discount pricing. Now remember, when markets are really moving really well, okay, we don't have to come back down into this bottom 25%. And as you've seen quite clearly here, it doesn't happen. If you've got a really impulsive market that has loads of weight behind it, as in there's loads and loads of buyers in this marketplace, it doesn't have to, and often won't come back to the 25%. The only area that we need to get to, and we absolutely need to get to, is the bottom half of any range. So the only mistake I would say on the trade that I took earlier is I was buying in the upper 50% of our 15-minute range, which does go against one of my rules. I'll tell you why I took it though. So I was looking at this trade like this. I saw how much momentum we had in the marketplace, and I saw how weak the reaction was from this weekly level. Now in hindsight, what we've got to remember is we're not going to get reactions from weekly levels where they just literally tag and reject like you do on daily levels. Like we see all the time on daily levels, you see this kind of movement where it takes out an area and immediately rejects, okay? It's going to spend some time around this level collecting orders, because there's lots of buying and selling going on around here. And just like I was buying in here, there was lots of people, and in fact this meant that we had more people selling than we did buying. That's the only reason price moves, remember. There's more sells in this section than there are buys. That's what leaves behind these imbalance candles. These imbalance candles tell us that there is, real momentum in the marketplace. So what I was looking at is I was looking at two things. I was looking at the fact that we were in this 15-minute range, which I'll get rid of just so we can see clearly. Okay. And I was also looking at the fact that we were within this 5-minute range. So I had two ranges lining up with each other. So for me, I was looking at this price action. I thought, right, we are in a 15-minute range. Okay. Yes, we haven't reached this equilibrium level yet. However, we are also in this 5-minute range, which hasn't been broken. Now, for me to want to go short here, okay, for me to want to take a short here, I need my 5-minute range broken. And I'll tell you why. Okay, we are overall bullish, okay, but we're bullish within the hourly time frames, okay? So we've got clear bullish price action there, but hourly range. We've got a clear new range being formed at the moment, bullish range. What we have done here is we've taken out here this external liquidity. Okay, so we've taken out our external liquidity. So it is an area that we could see reversals from, but because that is an external liquidity level on a hourly range, if you remember the numbers that we use, okay, if you're trading the daily ranges, you need an hourly change in momentum. If you're trading the hourly ranges, 4-hour ranges, you need a 15-minute change in momentum. If you're trading the 1-hour ranges, you need a 5-minute change in momentum. And if you're trading the 15-minute ranges, then you only need a 1-minute change in momentum. Okay? If you haven't got that written down somewhere, get that written down, because and get it somewhere easy to see. Put it on a post-it, stick it to your monitor. I don't care where you put it, just put it somewhere so you can see it. So you know that when you are trading, whatever liquidity point you're trading off from, you wait for the right price action to signal you into a trade. So For me, this wasn't a valid sell. Now, if you did catch a sell-off there, well done to you, good work. The only thing I would say on that is that was a risk entry because you were trading against bullish momentum. You had the previous week was a bullish candle, the previous day was a bullish candle, the hourly range was bullish, your 15-minute was bullish, and the 5-minute was bullish. This is part of the reason why the sells didn't hold, okay? Now, you may have got into a position here, but if you look at what happened in this section, there's nothing really in there that screams to me sells. You kind of get an ISC, you sweep that high there, you kind of get an ISC, technically it is an ISC, you've got a hidden MSU in there, so technically there's there, but when price is really messy like this, I personally think the safest thing to do is to sit on the sidelines and just hold your horses, okay? Now, the reason why I took this trade, okay, is because I had multiple breaks of structure on the 1 minute time frame. So I'm happy that the trade was taken in with the right confluences. I had multiple breaks of structure to the bullish side within a 5-minute and a 15-minute bullish range. So for me, the only thing I probably could have waited for to really solidify this trade is I probably could have waited for a engulfing pattern, okay, or maybe some lower time frame structure. But just like this 1 minute time frame pushed up like this, I might have missed the move. So look, I took the trade failed, I'm okay with that. In hindsight, probably should have waited until we had got back into the bottom half of this 15-minute range, but because of price being so momentous and so impulsive, and we had 5-minute range, which we were in the discount zone from, remember. So on my 5-minute range, I am in extreme discount down here, and I'm starting to get bullish price action, impulsive with imbalances, and then a new break of structure which took out that high to the left. That was the reason why I took the trade, okay? And so the one mistake I made is it should have been down here. Everything else was perfect. I'm happy to take that loss, chalk that up, it goes in my journal, I make a note of it. I will still probably take this trade again, because if it wasn't for that weekly level that we've got there, if it wasn't for that, then probably the trade would have worked out. Also, if it wasn't for the fact it was Monday, where liquidity is lower, there's less volume in the marketplace, then again, possibly that could have worked out. So look, it is what it is. It was a failed trade. If you caught the sells, well done. Not kind of trying to rain on your parade at all, but just be conscious of the fact that that was a very high risk entry and you were trading against a lot of bullish momentum. Now, what do we have here? So very, very simply then, once we had that pullback, my understanding of momentum and ranges is that we are now in a discount area, meaning that the ability for the price to go long again is greatly improved, okay? We are in a position now where we're coming into New York session, we've got an influx of liquidity in the marketplace, and we're now in a position where actually we might be poised well to potentially take some longs, okay? Just gonna, 2 seconds, change my view quickly. Where's that gone? There it is, okay. So we're now in an area where we should be able to look for longs, okay? Now, I was already in, and I'll tell you why, okay? I'm testing something out at the moment, okay? Now, we use premium discount, right? We know what that is, premium and discount, okay? Premium discount, and something I play around with quite often is I play around with what's called measured moves. So I take the range here, and I extend it from where I entered, let's say it's here, to give me an idea of where the range may extend itself to, effectively, okay? And the reason why that happens, the reason why we take these measured moves, is because it gives us an indication where price may move to, okay? There's a volume of liquidity that comes into the marketplace, we get that corrective pullback, the volume of liquidity that gets added into the marketplace normally will make it move in a similar fashion and create the similar volume of orders in the same direction. So I was playing around with this the other day, and I watched a couple of videos on fib extensions, and a few traders that trade similarly to us will basically trade these fib extensions. And what it does is it also gives you, I think, a really nice entry area, more so like a filtering process. So when we're looking at ranges and we want to understand where we should be getting into trades, it's easy well enough to look at, the bottom 75%, the bottom 25% of a range. But as you've seen, price doesn't often come down into these areas. So what I noticed, and what a lot of people talk about, is this golden zone. Now this golden zone is at that 62% level, okay, which is 62%, between 62% and 79% of the range. So it's kind of slap bang in the middle of our 50 and 100%, isn't it? It's like right in between those two levels. And if you look at any trades that play quite well, you'll notice that they often come into this level. Sometimes they'll reach a little bit deeper, they'll come down to the 79. Sometimes, like in this case, they'll find resistance at the 62, and then they'll rocket off like this one did. The reason why this happens is because of supply and demand, ultimately. And I'm not talking about supply and demand boxes. I'm talking about where investors look to buy and sell various markets, okay? They're looking to sell from here, which causes the pullback. Profit taking occurs, the algorithms then lure us into the marketplace with early pushes and then pull the market back down to take out more liquidity before the bigger move. And that's all that's happened here. This wasn't a particularly technical trade. There's no fancy analysis on this. I did put that post in the group earlier to say, can anyone tell me what they see in this? Well, what we do have here is a complex reversal. So we've got our false breaker structure, okay? That false breaker structure, what does that do? What does that do to traders, everyone?
Gets early buyers in, right?
Gets early buyers in, right? Okay, so early buyers come into the marketplace. They place their stops below this liquidity level here. And the algorithms, the big institutions, they sell it short again, knowing that there is a volume of orders sat below this level that can be taken to fuel this move. The way, if you look at it, and whilst it's not a conscious being, but if you look at it as if it were a conscious being, okay, they want as little resistance to push the market up as they can. So in order to do that, they push the market down, they take out early sellers. That takes them out of the marketplace, okay? It also tricks people into going short. I think a few of you were potentially considering shorts from here. If you did get a short down to here, great. If you got stopped out, apologies. Again, it was tough market to read today, okay? But what we've done is we've triggered in set buyers who have been taken out by this liquidity raid. We've triggered in sellers because they feel like it's going short with these impulsive candles. They then get stopped out by these initial pullbacks. And then we've got the trap sat above as well. So we have a really clear complex reversal here, okay? False breaker structure, true breaker structure, liquidity trap down below, okay? Sweep, and then we're looking for the MSU pattern, which we get here. MSU pattern, which we get here. Really, really clear MSU. So we've got structure, all these structural points. They're swept, they're raided, engulfing pattern, stop below the low. Really, really lovely trade. So that is one of my favorite, if not my favorite, reversal pattern. It's so clear, it's so obvious. Once you have that initial push, then a liquidity raid, you know, you could bet your mortgage on it. It plays out so regularly. Within context, of course, we have to make sure we're in, an area where we're looking for longs. So why am I looking for longs here? Well, we're in that 15-minute range. We've taken out liquidity within here. We've tagged into an imbalance. We've had an initial push showing that there is a desire to go long. We've got a New York open trap sat above as well. And the most important thing over everything that we have to remember is previous weekly candle was bullish, previous daily candle was bullish, we're in hourly bullish price action, and we're in a 15-minute hourly range. And then what does that false breaker structure give us? This one here. Can anyone tell me? What does this move give us?
Gives us the indication that it's starting a reversal.
Yeah, more literally though, what is it? What is that now?
Like a new 15-minute range, do you
It's a
mean?
new
Or 5-minute range,
5-minute
sorry.
range,
yeah.
exactly. It's a new 5-minute range.
External liquidity.
So now we've got a new 5-minute range with external liquidity. So, you know, we're if you were selling from there and you came out at the lows, this is where internal and external liquidity are really, really important, guys, because price moves from external liquidity to internal liquidity, then from internal liquidity to external liquidity. That's the market cycle, okay? We've taken external liquidity here, so we are expecting internal liquidity to be taken, which is done here, which is done here. We've then created bullish structure within all of these other bullish ranges and momentums and timeframes, and we've taken out more liquidity. So we are taking out all the liquidity internally that we need to, and we're now creating bullish structure, which again takes its own liquidity. When this happens, and you see this cycle happening, it's a really clear indication that there's manipulation going on in the marketplace. You've taken liquidity out, then you've had a push up, that will trick buyers into getting into the marketplace. You take their liquidity, then you have a push up, that will trick buyers to get into the marketplace. You take their liquidity, and now when you've got timing on your side, various other factors, you're in a position where price, even for a Monday, can absolutely rocket up, okay? Now, one thing that I really like about the fib extensions is that they give you really nice areas to aim for. That's what I quite like about it. So if I just go and add my trade back on, just so you guys can see it again, 2 seconds. It's that one there, okay? So for me, it gave me some really clear areas, and what you'll notice is that how price reacts to these areas as well, okay? So obviously you've got a reaction to the external liquidity, okay? That was where I took my first profit off. Wish I'd held it, if I'm honest. That's where I took first profit off, okay? I secured some profit, locked in break even, and then I held out for my next profit target, which was here, okay? Price took that out really easily as well, but you can see how there's like this resistance to these levels, okay? There's a reason for that, okay? Because there's only so much momentum and liquidity in the marketplace, and the fib extensions are, the reason why they're used so commonly is because there is a pattern to these marketplaces. There's a pattern to where traders and investors will take profits off, where their algorithms expect orders to be, and what these do is they give us a really nice guideline of where we could be headed for. Now, I would personally only use these really in line with higher time frame momentum. For example, if I was selling, I know where my target is. If I'm selling and I take that short, okay, I know my target is limited by all of this internal liquidity. So I'm probably not going to hold much past the 50%. So I don't really need my fib extension here. What, however, I think is quite good to do is a couple of things. Gives you a real good guideline of where you should be aiming for targets, okay, which is, I think, really helpful. Second thing I think it's a good addition to do is to give you a really clear target for entry. Rather than just expecting it to come down to this bottom half, there's something about the golden zone, as they call it. There's something about that area which is really sensitive, and knowing that your price chart has come down into this area will give you that extra bit of added confidence in your trade, knowing that you're in a discounted area where price is likely to reject from. Now, my original stop was down here. I obviously tightened that stop as we went on. I had another position where the stop was below there, and you know, you can place your stops however you want. The safe stop would be down here ultimately, okay? With this one, it went a little bit tighter just because I was very, very confident on the bullish momentum coming into the marketplace. We took 3R out of the market, which covered my loss from this morning, plus gave me 2R on top, put me 1% up for the day. I'm really, really happy with that. And you know, ultimately, this is the sort of decision-making process you need to go into when you're taking trades, okay? Those of you who are trying to take the short from there, that for me is a completely invalid trade. The reason why that's an invalid trade is we've just had a bullish push within a bullish range. That's a first red flag for me. But also, we haven't actually got any real clear, you know, bearish momentum. Remember, when you have one push like this, all this really does is give us a pullback, right? Really, to truly confirm a bearish momentum market, you need that to happen. And then you've got plenty of time to probably buy back up and sell back down. So don't be in a rush to force trades just because they're at liquidity levels, especially if it's a weekly level. That's a really, really important thing to note, is that weekly levels will move a lot slower. Price will spend normally a lot more time than this. Often price can spend days at these levels. They can literally spend days at these levels, taking out liquidity, building up orders, tricking people into going long, tricking people into going short. But looking at the DXY at the moment and looking just how bearish it is, you know, this isn't momentum that I want to be fighting, okay? With DXY, real clear indication again. We get that complex reversal there. We have our trap, okay? Then our true breaker structure below the New York Open trap. Price is really struggling. See how price is struggling to get long, okay? Yes, you could have been lucky and got some trades up to here, but sometimes it's worth just watching and waiting. For example, I know all my momentum at the moment is bearish. So yes, you could have caught a buy up here, but why? You ask yourself why. Do you need to trade against this momentum? Because price could have easily done this morning, right? Easily done that, okay? Drew on my fib with this one. We didn't get into the golden zone, as you can see. That, for me, was good because I could see that this price action was happening. I could see that this price action was happening at that 50% zone. That tells me that there is a lot of weight behind sells on the DXY, okay? That's a lovely thing for me because I know I've got, this is where we get like the SMT divergence, right? So we're looking at divergences between price charts. Well, we've got this one that's really heavily bearish and struggling to get back, and this one that is getting back quite comfortably. That indicates to me that there is now a load of force behind this trade. And look at what happened. You know, if we'd held up to the daily liquidity, we'd have had a lovely 5-hour trade. I could be, you know, nearly 3% up by now. You know, that would be a fantastic end to the day, and fantastic start to the week. So, you know, waiting for all of these confluences to align, I think, is a really, really important skill to develop. Not forcing and rushing trades just because you've got to a liquidity area, because remember, everyone's trying to catch reversals, right? The safest trade is always the continuation trade. Always. Whether you're at a weekly level, daily level, it doesn't matter. How many times do we see daily levels tagged? We get a small rejection and then we get a big price move up. So when price is bearish, it will tell you that it's bearish. It will create structure, giving you a really clear understanding that it is bearish, okay? If you are looking at this and saying this is really bullish, I want to try and catch a short, you need to be really fucking sure that what you're doing is the right thing. And you need to have loads and loads of confluences in your favor. And even if you do catch that perfect trade bearish, you've got to remember that it's ultimately limited probably by the discount range, or maybe if you're really lucky, the external level. But for me, looking at that, thinking, do you know what? I could reverse at the 50%. Like if we were trading DXY, and we were taking that long, it's reversed at 50%. So really, if you're playing counter trend to the higher time frame range, which in this case is the 15-minute range, you have to bear in mind that your trade potential is only around 2R. Now, for me, that's not enough. I need my trade potential to be like 4, 5, 6R. If I've got enough room for my market to move that far, then that for me tells me, well, I can get my 2 to 3R out really easily, right? So I've got loads of room and I've got loads of potential in that trade. So if I only need half of it or 3/4 of it, that for me, that puts odds in my favor. So I think really the lesson from this today is follow momentum always, okay? Start acknowledging what your previous week's candle was like. Because if your previous week's candle was bullish, and you look at last week's candle, okay? Look how bullish that candle is. Well, the likelihood is that we'll get a small pullback and then a bullish continuation, just based upon standard, basic candle theory. Every single day, I acknowledge what the previous day's candle was like. So again, bullish candle, okay? We did some stats the other day. I think Sam and Anton, potentially, we were sat down looking at some stats. I think 65% of candles, once they close in a particular direction, will continue in that same direction the following day. So that indicates to us that actually, if you've had a previous day that's bullish, the likelihood is that they're going to be bullish again. And that will give you maybe an extra added confluence. Then you can look at your hourly ranges and see what your hourly range is like, which by this morning was a very clear bullish hourly range. So you've got all of these momentums lining up with you. It really is just a simple case of just trusting that the likelihood is that it's going to continue pushing bullish until it reaches an area of liquidity that it is aiming for, targeting, that the algorithms are targeting. But at the moment, the DXY is just so heavily bearish, and we've got so much liquidity sat below, imbalances, liquidity levels, there's no reason to fight against it, okay? We might get some long opportunities this week. We might get some really nice, clean, bullish pullbacks. But again, you've got to remember that whilst you might get a nice bullish pullback, you could get a bullish pullback tomorrow, bearish pullback tomorrow that comes all the way down to there. You have to remember that you're trading against momentum. It's going to be a slower move. It's going to be harder to get to your target. You need to come in and out of the marketplace quicker. That's where if I'm playing counter trend, I'll only go for between 1 and 2 R. Whereas if I'm going pro trend, I'll go basically wherever my liquidity points will take me. I've started using the fib extensions wherever they will take me, and really focusing on getting your theories aligned so that you can get yourself into better trades. GBP USD, again, another perfect example of what we're discussing today. So let's see if we get the golden zone. So there we go. So this is the range. It's a 15-minute range from this low to this high. Price comes down perfectly into that golden zone. We then get our setup within that golden zone, and then we can reject from there. Now you can use these golden zones as well on the lower time frames. If you want a really, really nice tight entry, you could look at, for example, this low to this high, and then we didn't get an entry on that one, so let's try the next one, this low to this high. Okay, and then you could take a long like this, so you could use this on your lower time frame as well. Okay, to then look and again look at how price reacts. So it gets up to the 50 and it rejects, bounces back down to the 100% or 0%, goes back up to the 1, then rejects, goes back up to the 1.5 and then rejects. As you see, these areas are really sensitive because they're areas where price is likely for profit taking and order filling and things like that. So it's a really good tool, I think, to start using. The way I'm using it, just so you know, is I'm using it on my higher time frame ranges, and I'm using it to give me areas where I can expect my entries to come in. So this one, as you can see, really, really perfect. Exactly the same setup as on Euro USD. False breaker structure, liquidity raid, true breaker structure, enter in on the MSU. I'll put that in the chat if you saw earlier. Really clean MSU there. Rejection, enter on the engulfing, stop below the low, and that was another easy 3.29 out of the marketplace. Did this one continue on? I'm not sure. Yeah, this one continued on, and as you can see, it's almost tagged perfectly that 0.5. That would have been a 6R trade pretty much if you'd got in on that one. Gold did exactly the same. Okay, exactly the same setup on gold. And when you can see this happening, when you can see these, these trades lining up like this, so you've got 3 pairs that are often very in line with the DXY. They've all come down into this golden area. They've all given us a setup. It can be quite alluring, can't it? You could want to take the entry on all 3. The risk that you face there is that if all 3 lose, or if you take two of them lose, then you lose twice. Obviously, the benefit is if they all win, then you win double, but it's effectively like doubling your risk. So you double your wins, but you double your losses if it does, return on you. So it's not something I'd advise you to do. Personally, I would say take the cleanest setup or the pair that you feel most comfortable trading, because that can usually then get you into, the trade that you're happier with. For me, I saw much more bearish structure on gold today, so that was a paper trade for me. I saw much more bearish structure on gold. I also saw a failure to make a new high, whereas Euro USD, as you can see, did make a new high. GBP USD did make a new high. Gold didn't make a new high. So for me, that was a bit of a telltale sign that we could be going short from here. and the gold chart doesn't always completely line up with DXY, but the fact that all three of these pairs have made the same move today just shows that the dollar is in control at the moment, okay? The dollar is in firm control of all three of these markets today, and if you're not using the DXY in your analysis and you're trading one of these pairs or any pair that has dollar in its pair, then you need to start looking at it. All your major pairs, USD JPY, USD CAD, USD CHF, all of your Aussie USD, they all follow the DXY relatively closely, certainly from a higher time frame perspective anyway, unless there's major events or economic details going on within the country of origin, like in Australia, for example, or in the UK over here. You should be using, you should assume that these pairs especially are going to follow pretty much in line with what the DXY is doing, okay? So that was today. What we do from here, I have no clue, if I'm honest. I expect we're going to have probably a bit of consolidation overnight, maybe a pullback overnight. If we do, I'll happily look at longs from here. I wouldn't be interested in getting into anything short until I've got some real clear short confirmation. We've got FOMC on, is it FOMC Wednesday, team? It's the last Wednesday of every month, isn't it? Are we on the last Wednesday? I don't know. Anyone help me out here? Oh, what day are we? We might have FOMC minute, I'm not sure. Or it might be just minute notes. There's something on Wednesday anyway. And then we've got, I think, something on Thursday as well. So, you know, we'll see what tomorrow gives us. And, you know, hopefully we can catch some positions off, you know, the aftermath of today's move. We may find that we have just a really corrective week until we get some news injected. I don't know really, so we just have to wait and see what the market gives us. But yeah, look, start playing around with your fib extensions, have a look at that golden zone, see how well that kind of gets you into trade. Maybe it gives you a bit of a filter as to when you should be getting into trades. If you've got a bad habit of buying up high or selling down low, maybe use your fib extension to act as a filtering process of when you should and shouldn't be trading, or when you should be looking for the higher value trades. And I think the most important lesson for today is just trust your momentum, guys. We've got bullish momentum all over this marketplace. Trying to sell into it is normally a bad idea, regardless of what liquidity points we're at. If the market has enough momentum and liquidity, it will blow through these levels like it's done here. It wasn't a particularly strong weekly level. It was like one of these inside weekly levels, so it was nothing particularly special anyway. We do mark them on, we do keep an eye on them as they're areas for profit taking often, but as you can see, the market has just blown through them and continued blowing through them today. That's where we are. All right, any questions for me? Always makes me nervous when you guys don't have questions.
Well, I've got one about, you know, how you're saying it was a clear 1 hour range today. Mm-hmm. Even though it's really high up, you're just looking at kind of local swing points, I guess you call them.
Yeah, so basically...
Just the most recent, like, obvious kind of low.
Yeah, so basically, my range... So imagine we don't have any of this price here. So imagine it's the morning, okay? This is still within this hourly range, because all this is at the moment is just an external sweep. So for me to have a new range created on the hourly time frame, I need a clear chain, I need a clear break above and close above, and you know, like that. Okay, that now gives me a new range that I can be looking at, and I can get rid of that effectively. That's effectively the new range that we're in. So for me, and I'm looking at this, although we are in the premium zone of this hourly range, for me, I'm not fussed on my hourly ranges, whether we're in premium or discount. I'll take buys and sells wherever I like, because I've learned over time that it doesn't really matter in the hourly ranges where you are. Price can do whatever it wants to. It's the 15-minute ranges that I'm a little bit more loyal to. And, you know, like we discussed earlier, the mistake I made earlier is I bought within premium, but everything else in the setup for me was clean enough. Maybe I should have just held off on that, because technically I have invalidated one of my rules there that you don't buy in the premium with a 15-minute range. Maybe I was a little bit eager, but I saw enough confluences for me to get in. So when we're in the ranges like that, when we're in these hourly ranges, I've got all this momentum.
Why that low? Why did you choose that low today? was it like because it's Asia low, just because it's
which low?
This one, the one that you bought in premium of.
Because that was the most recent 15-minute range.
Yeah. Okay.
Okay. So
like,
from the lowest.
Because I wasn't sure today. That was basically I came into the market.
Yeah.
And I saw that low, and I was like, is it or isn't it? And I had the like daily,
with you.
external. So I wasn't really sure, you know what I mean, where my premium and discount was today.
So
apart
basically,
from the big one that was printing.
Yeah. So basically, if it's not clear, what I will do is I'll look at the most obvious recent swing. So for me, if I get rid of that, I'm just looking at this chart. For me, when price is up here, the most obvious recent swing, and obviously I then was clear on this when I started to have that breakdown. For me, the most obvious recent swing was from this low to this high, because it took out the liquidity to the left, took out this liquidity. If you look at literally the range, if you look at kind of the 15-minute structure, so you had this big move up like this, okay? I wouldn't really factor that as a range, if I'm honest. Let's just take that high because it clearly took some liquidity and rejected. And then you've got this tiny little 15-minute range here, which then is invalidated anyway. I wouldn't class that as a new range, that section. Okay, this is where it can get subjective. You could do.
It's only one candle pullback too, right? You can see the difference.
Yeah, exactly.
The candles now.
Because that's so wicky, that for me that doesn't tell me that is a range break.
Yeah, it's not like
like a liquidity sweep.
I understand what you mean.
But if you're being a purist, technically that has broken liquidity to the left. So that would be our range low, and then we get this big push up. So I think this is where real common sense prevails. So yes,
both were valid for the longs today, though, right?
Say again.
Whichever you use.
Yeah, exactly. Yeah. We could have used that. Yeah. I don't think it matters a huge amount either way. Either way, we would have been in roughly the same area to get into the trade. Roughly in that, this kind of lower portion of the range, whatever happened. And again, we've got to factor in everything else as well. It's not just the range, of course, it's the liquidity, it's the imbalance, it's the setup within the key time frame and things like that. So there's multiple things going on. What I'll always try and teach you guys to do is to be factoring in multiple confluences. It's not any one thing that signals you into a trade. It's you need to have enough confluences that line up with your trade idea, so that so that not taking the trade seems like the wrong thing to do. Okay, and it's not how many confluences can I find so that I can take this trade. It's how many confluences are there that if I didn't take this trade, I feel like I'm doing something wrong. Okay, and it's a slight change in the psychology of it, because if you try and find reasons to get yourself into a trade, you'll talk yourself into more trades all in all. If you're looking at trades and looking at them and thinking, do you know what, there is so much bullish confluence here, I can't not take this trade, that for me is the trades you sort of be taking. Those are your obvious ones. We always say, wait for the trades that are so obvious you can't not take them. It's a real key psychology change that I think everyone needs to master and develop. Okay, don't find reasons to get yourself into trade. Find reasons.
That's exactly what I did today.
Yeah.
Yeah, just off the external liquidity sweep,
exactly,
right?
Yeah. And I get.
I was aware. I just more kind of expecting like a deeper pullback, I guess.
Yeah. But remember, if you are going to get that, so if you are counter trend, okay, and you are going to get that, you're going to have loads of opportunity to get in, right? Okay, there's going to be loads of opportunity to get down there, and we only need one of these swings to make our profit potentially for the week. Okay, look at this bullish price action. Okay, look at how many options there were to get in. You could have got in here, you could have got in here. We know you could have got in there. Again, look at this bullish price action down here, okay? Multiple entries. Asia sweep there, you could have got in. You had a pullback here, you could have got in there. You had continuation here. Do you know what I mean? There's multiple opportunities in these swings, because what we're doing effectively is we are swinging the marketplace, but we're day trading the swings. That's what we want, right? We want these big moves, and we want 2 or 3 opportunities to get in. Well, the market will give you plenty of those opportunities to get into the marketplace. You don't need to rush it, okay? And trying to catch the very top will, as you've probably found over your time, is generally a losing strategy. So be really cautious with that. And if you just look at if you were just trading, for example, the 15-minute ranges, until this range is broken, okay, and even then it's not bearish, because all that is right now is a pullback. Okay, we're not bearish until we get confirmed price action, right? Because in the same way that we've had this setup here bullish, all that could be is a liquidity sweep to take the price long again. Yeah. Okay, that could just be a liquidity sweep of external liquidity to take the price long. And in fact, if we did get that sort of move, I would absolutely be looking for longs here, taking out external liquidity. If I can get a bullish setup, my likelihood of getting that high is much higher than waiting for a pullback. And do you know what? If we get up to here and then we start making bearish structure, indicating that we're going to go bearish, you can close your bullish trade and you can enter bearish if you want to. Do you know what I mean? So I think sometimes we really want to catch every swing position. We want to catch every high, every low. And actually, if you just take a step back, be a little bit more patient, hold fire, just wait and see what market gives you, then that patience, we talk about all the time, right? Patience is key, yeah? Patience is the one discipline that every trader needs. It's really, really important to develop because it takes a long time to get it right. When you do get it right and trades like this come out of the marketplace easily, it's a really, really lovely place to be. So if you're ever unsure about a trade, or if you feel like you're forcing or rushing a trade, just take a step back. If you miss it, you miss it. You can put that in your journal and you can work on it from there. If you don't miss it, then you'll be very thankful that you did sit on the sidelines.
Yeah, thank you.
That's your lot.
Good stuff.
I'll get this is all recorded, guys, so I'll get this uploaded for if anyone wants to watch it back. I'll be in the charts tomorrow morning, of course, as always. If you need me at all, give me a shout. I might do some live trading tomorrow, actually, if anyone's around. Depending what the markets look like, I might jump onto the Discord and just sit in there live whilst I'm doing my trading session and London Open, and we'll see what we find.
Yeah, that could be cool, huh?
Cool. Alarit. Right, lovely to see you all. Take it easy. Have a nice evening.
Thank you. Bye.
Cheers, Andrew. See you later, dude. Bye. Bye.